Questions on IFRS 3 before we jump off? Are we all happy with IFRS 3? Okay. Karen is good. Anyone else? Any questions before we jump off? Are we all good? Do we have a sense of what is expected? Because for me, I just want you to I just want you to have this sense, so that when you read the standard, and I love the engagement that we've been having, because it shows that you are able to engage with the standard. And that's what these sessions are all about, that once you are aware of something, then you go probe the standard and you find that, oh, wait, this is what he was talking about. Oh, I also see that even this that he didn't talk about is actually addressed. And therefore, if the examiner tries to throw this in the final exam, I'm cool. So that is the idea here. Okay, so that is IFRS 3, but wait, there is a comment on what? There is a comment on WhatsApp. So maybe tell me your understanding, Sihle. Maybe you can open your mic, just tell me your understanding, then we'll just talk about whether we are in agreement or not. Maybe quickly do that. Maybe you just missed a thing or two and we can just quickly clarify without going into the entire explanation. Can you go? I think you must be on Zoom. Walter, can you just check on Sihle, please?
Hello.
Hello.
Hi, Daddy.
Yes, how are you, Sihle?
Well, thanks, and yourself.
Good. Yes, what would you like to clarify?
I think I got lost where you said the part where you said when you then sell the asset. I think if you can go from there where you sell the asset, what did you say you do?
So let's just then paint the entire picture. So let's say the acquisition date was 30 June, right? 2020. Then the year end is 31 July. And on 31 July, I have not yet finalized my business combination accounting. Maybe the asset is just difficult to value, or maybe it was not found. Then I just then assumed that let's put 100,000 so that we can do goodwill and report on this transaction. So we then put that 100,000. Then come August, or maybe September, the asset is then sold. And we are seeing that it's been sold for 150. So the standard is saying that, but the time from the acquisition date, which is 30 June, to the time that you sold the asset, it is a relatively short period of time. So even though you didn't know the fair value of the asset on 30 June, just because now you are selling it in a relatively short period of time, it could actually indicate the value of the asset on 30 June. Because they are suggesting that values of some of the assets do not change on a daily basis. It's not like a share, but they don't change on a daily basis. You don't wake up and you find that the building was 100 million today and tomorrow it's now, say, 90 million. So if now we are talking about a sale that occurs in a relatively short period of time, we can then say, if we have not yet finalized our business combination accounting, that might be reflective of the true value that was there at acquisition date. Does that make sense?
Yes, that makes sense. Do you then adjust the amount from 100? Do you then
yes.
put a favorable adjustment?
Yes.
Amount from 100 to 150?
Yes. Or otherwise, you just go back and you assume. So in an exam, you'll ignore 100,000 as if you never saw it. You'll just calculate goodwill with 150.
150.
Yeah, so maybe let's say the original carrying amount of the asset was 90. So your fair value adjustment will compare 90 and 150, and you will ignore the 100.
All right.
Yes.
Thank you.
Okay. So that is how the measurement period principle works. So the exam technique is that the first fair value is what the fair value will then be the fair value determined in the measurement period. All right, then we've got what? We've got just some talking points around fair value adjustment and intergroup transactions. So the one thing that I just want to emphasize when it comes to this is just to emphasize that it is so important for you to be able to understand the subsequent measurement of assets. That's number one. You need to understand the subsequent measurement of assets. That's one. Number two, you need to be able to what? To see the initial accounting. So you need to be able to see the initial accounting. So those are the kind of things that you need to what? Those are the kind of things that you need to get right. So those are the kind of things that you need to get right. So the first thing is to do what? Is to understand the subsequent measurement and the initial accounting. So for instance, if we look at that situation in Joe, so what we are now saying, we are saying that we will have fair value adjustments at acquisition date. And fair value adjustment, that is essentially what the cost of an asset is to the group. Then it will be recognized according to what? It will be recognized according to the IFRS. So if it is a PPE, it will be depreciated. If it is a PPE, it will be depreciated. If it is inventory, it may be written off. That's what I mean when I say you need to understand subsequent accounting. So this is when we realize the fair value adjustments. So the realization then simply means that according to the group, they see something that the subsidiary itself does not see. So that is what we then have in mind, that the group sees something that is different from the subsidiary, and that's why there is a need for an adjustment. So that is how you deal with what? That is how you deal with the fair value adjustment. But let's quickly talk high level on the situation that we had in Joe. So we have, let's say, carrying amount of 100. Then let's say that the fair value of the asset was 120. And then it means what? It means that there is fair value adjustment of what? There's fair value adjustment of 20. Agreed? Then if we provide for tax, it means that tax at 28% will then be 5,600. Okay? Then let's say the estimated useful life of this asset is 4 years. So essentially, the group, what we are seeing, the group will say, but the cost of this asset to me is 120. And the subsidiary will then say what? The cost of the carrying amount is 100,000. Then the depreciation in year one, will then be 30,000. So let me have tax here. Then the difference is 20. Let me have difference. Then tax will just be at 28%. So then we'll then say in year one, we have depreciation of 30, which is 120 divided by 4. Then here, it will be what? It will be 25. And this will be a difference. So the difference of these two will then be 5. And we have now a net difference of 15, which is 90 minus 75. That is how we have it. Then next year, we'll then have depreciation again, 30, and we are sitting with 60. And then here, we'll have 25, and we are sitting with what? With now 50. This means we've got minus 5, and we've got what? We've got 10. So that is what we are doing when we deal with fair value adjustment. And you might then have said that, but I've always just take the 20,000 and divide by 4. That is perfectly fine. So there's nothing wrong with that. But now let's consider when there is now an intergroup transaction. So the intergroup transaction, the group will still see what the asset at what? At, so let's say that there is, the asset is sold and it's sold for, let's call it 57,000. So the asset is called at 57,000. And then it means that there is what? It means that there is a profit of 7,000. And according to the group, because this is what, this is an intercompany transaction, do you agree that the group will say no profit because you guys are just trading with each other? But accounting wise, it means that the asset is now sitting with what? It's now sitting with another group company at 57,000. And therefore, what it means that the difference between these two amounts is different. And we have a difference of 3,000 because the 7,000 will be reversed since there is no what? Since there is no, since the carrying amount changed, and therefore the difference between what the group sees and what the other company sees has now what? Has now changed. And then the next thing will then be to continue to depreciate this over the 2-year remaining period, which will then mean that we are still sitting with what? 30,000. And here it will then be what? It will then be 28,500. So that is how this is what? That is how this will then work. And therefore, this will be 1.5 and this will be 1.5. So that is how you deal with an asset moving between the group companies. So you deal with it in this particular way, where now the group amounts are not impacted, but the subsidiary amounts are now impacted because it is moved from one group company to the other group company. But you are focused on tracking this. So this will always be tracked, but it just means that you need to be careful that this profit, it is like it will move you closer to group numbers, and one could argue that you've realized a portion of it. But do you see how you deal with what? Fair value adjustments and intergroup transaction? Because intergroup transactions are all about this, the difference from what the group sees and what the subsidiary has. Okay, then the next thing is what? The next thing is, oh yes, so those are some of the things that I just wanted to clear up so that when you look at Joe, you then appreciate it. But whenever you are in doubt, this is what you need to deal with. But now let's deal with that monster of what? Monster of intergroup list. Intragroup lists. So there are questions on teams. What is the subsequent treatment of an indemnification asset? Remember, the indemnification asset does not exist on its own. It links to what? It links to the contingent liability. So the indemnification asset said it cannot exist on its own. Then, what is this realization? Remember, let's use full sentences, guys.
So when you were busy doing the difference you know, when they sold this asset here and then there was the difference. So I'm saying the difference, that isn't that like it's a fair value adjustment, and then as you are reducing the difference, isn't that realization? Or am I confusing it?
Yeah.
Is it correct?
Yes, but what are you asking?
Oh, yes, that's what I'm asking. If that action is the realization, right? The difference between the two.
Yeah, the difference column, yes.
Okay, thank
yes.
you.
All right, so now I'll want you to go look at Joe, but let me just walk through this thinking. But this is how it works. Remember that we've got two companies. It doesn't matter which one is which. So it doesn't matter whether it's the parent or it's a subsidiary. The only thing that it will just matter is whether it will impact the NCI or not. But we'll get to that. So now let's say that I've got one of the subsidiary company or one of the parent company. It's a lessor, and it has classified this as an operating lease. So, and then we have a lessee. So we have a lessee and it's the other group company. So we know that this what? This is single accounting approach here. And then now we are seeing let's just have some dummy numbers. So let's say that on lease inception. So on lease inception, let's say that it was agreed that this is a 2-year lease. So I'm just going to keep it simple. It's a 2-year lease. And the year one payment, in year one, the payment is 100,000. And in year two, the payment is what? 200,000. Then what? Then the next thing is what? The next thing it's let's say we did the present values and we determined that there is a right of use and the lease liability. Then the right of use, let's say that we determine that the present value of this, let's say what? So I'm just going to have them in numbers. Let's say 220. Then what we are now saying, we are also recognizing that because we are a lessor and this is an operating lease, there will be an investment property. And then let's say that the carrying amount when the lease was entered into was 1 million at lease inception. And then the fair value is at year end. Let's say then the fair value was 1.2 million. The estimated useful life is 10 years with no residual value. This is what? This is the situation we have. So maybe just quickly copy it so that we can quickly talk about it. So let's say at interest rate. Yeah, it will not come. I'm just wanting you to look at this so that we can appreciate what we want to do. So do you have this picture? So just to summarize, we've got a 2-year lease between group companies. The payments, year one, 100,000 has to be made. Year two, 200,000 has to be made. Then the present value of these two payments was done at an interest rate of 12%, and we come with the right of use of 220 and the lease liability of 220. Because remember, the lease liability and right of use on day one are the same. Then the carrying amount is 1 million at lease inception of the investment property, and at the end of the year, it's 1.2. So now walk with me. Tell me in the lessor's books, remember as I was saying, know the initial accounting. So let's have the lessor here and let's have the lessee here. Now talk to me about how you will do it. Talk to me about how you will account for the lease in lessor's books and in the lessee's books. Tell me. Tell me. How will this be accounted for in the lessor? Let's start with the lessor. So give me the lessor. Let's start with the lessor only. Give me the lessor's accounting in year one. We're just going to look at year one. Okay. Let's go, guys. What will be the entries in year one in the lessor's books? Lessor. Give me the entries. Why the sad face? No, not gross investment. Why the sad face though? Sit there. Ah, guys, no. What do you mean? No, guys. It's an operating lease. As I'm saying, it's an operating lease. You got investment property. No, no, give me that one. No, give me something. Yes, yes. That's why I said, remember that we've got what? An investment property. If it's a if you talk about gross investment, you cannot have gross investment and investment property in the same books. That's not possible, because gross investment exists when you derecognize the asset so that you can bring the gross investment. So the two will not ever work together. Okay. Now that clarifies things. Let's go. Debit bank credit list receivable. Debit bank credit rental income. No. So in lessor's books, investment property at fair value, I think. No, yeah, that's why I gave you the fair value. So now let's make that a fact. The lessor will maintain the asset in his books, therefore continue to depreciate and adjust for fair value. No. Guys, where's your factory? Yeah, where's your factory? So you see what I was talking about, that you really need to get the initial accounting right. Okay. Let's do it step by step. So is the lessor, he's got the operating lease, because we know. How do we know? Because we are told that there is what? An investment property. And as I'm saying that I've given you the fair values. So what you will then do, you'll then debit the investment property, SFP, credit the fair value adjustment, P&L. And in my simple example, the asset when you entered into the lease was 1 million, and now it is 1.2. So that means there is 200,000 fair value adjustment. Agreed on step number one. So let's agree. Stop me if it's not looking familiar. Do we depreciate the asset? No, because fair value adjustment or fair value model does not have depreciation. So that means the useful life is not supposed to be used altogether. Then the next thing will then be what? The next thing will then be we straight line the lease payments to the lessor, because if it's an operating lease, he will want to straight line. So he will not just recognize the 100,000 as it is. He will take the 100,000, add it to the 200, and he will divide by 2 to get what? To get to the 150. So in his books, he will then debit bank of 100,000 in the current period. All right? Then he will credit the lease income, P&L, of 150,000. And he will then have what? He will then have a difference of lease asset arising from what? Arising from the operating lease straight lining. Are we all clear? So, you know, the investment property is not always measured at fair value. Remember that we can choose between fair value and cost. It's just, it's fun when there's what, when it's at fair value. Otherwise, the question tones down quite a lot. Okay? Guys, full sentences, Karen. Full sentences. Then, on the other side, what are we having? We are saying it's a lessee, and it's not a short-term lease. A short-term lease, therefore, we have right of use as an asset and a lease liability, SFP. And this is 220. Because I gave it to you, but you know very well in an exam, the examiner might expect you to calculate it, but I'm giving it to you. Then you then say the right of use is what? The right of use has to be depreciated. The right of use has to be depreciated. Agreed? So that is P&L. And the right of use will then be, so it's a 2-year lease. So it will be 220 divided by 2. And that will be what? That will be 110,000. I'm sure it's coming now. Like, oh yes. Then the next thing, let's have a payment. Yes, so then there will be what? Then there will be the lease liability. So the lease liability, remember we are paying, so we'll pay 100,000 because we are lessee, we are paying. And I'll accrue interest at what? At 10% on the lease liability. Then I'll have 10% at 220,000, the lease liability, so it's 22,000. Then at the end, what will I have? Lease liability will be paid off, and in this case, I will have what? I will have 78,000. So it's other accounting. So let's see. So I think Sbusiso and Nondumiso response, so it will be handled by the response that we have here. No, Karen, what do you mean straight lining? Then is that annualizing? But the standard cost is straight lining. Why are you guys calling it something else?
So what I'm asking, you said depreciation, there's no depreciation on fair value model, cool. And then underneath it, you did straight. So you added the 100 plus the 200 over 2, divided by 2 is 100. Then you debited bank, lease asset, and then lease. So I'm asking what's going, can you repeat that situation there? Because I'm not sure if I understood, but I'm like watching the screen, so.
All right, I'm trying to be mindful of the time, and wondering whether I should pass this to Asen, because there's quite a lot of leasing principles that are involved in that regard. Are you guys very lost? Yeah, because I don't want to continue if you are very lost, because we might be missing the critical elements.
I don't think we're very lost. We just need explaining that section, because I think what everyone is also asking is the depreciation, is that annualizing, is all that section that we're all asking.
Yeah, I know. Not very lost. Okay. Why is this losing you? Maybe let me ask you back. Why is this losing you?
Because I'm not really sure what you're doing.
How should I be doing it, according to you?
Well, the thing is, I don't know what you're doing in the first place. So I know what debit bank means is money coming in. And
Yeah.
these assets, I'm not sure what's going on there.
But what would you want to do?
Well, I don't know. What is this channel trying to do? Maybe if I understood at least the narration, then I could answer you.
But it's accounting for the lease. That's their journal.
Okay.
Yes, that's why I'm saying that. How do you want to account for this lease?
Karen, it's equalizing.
Mm.
So maybe, I don't know. So equalizing, maybe, what does equalizing mean? So is there a simple way to say it? I don't know.
We are making the payments to be equal.
Yeah, I get that the lease asset is the balancing figure, but okay, so bank is money coming in. Then what's this credit lease IN? What's that?
Okay, maybe let's keep it to break, because these are the issues with the leasing, that this is how you account for an operating lease. So that's why I'm saying that. Why are you very lost? Like, what are the basics in terms of accounting for an operating lease without complicating it? That the straight lining is the only way. Not only, but the most common way, the one that's the standard talks to.
Okay, so I guess I didn't grab that section with Alson, so that's why I'm confused.
Yeah, that's why I'm saying that, and I don't want us to then derail, because I want us to just focus on the consolidation, so we can pick it up during break perhaps, if you are very lost with the basics, because that would be a different one.
Okay,
Yeah.
I'll wait for the break, thank you.
All right. But as I'm saying, that this example would be confusing if your leasing basics are not there, and this as well is the leasing basics. So the initial accounting is what is quite important. So like on these years, we are saying that we've got what? We've got the right of use and the lease liability. That's what the standard tells us. Then we've got the depreciation. That is what the standard tells us, that once we have the right of use depreciated, then we have to depreciate what we recognize, which is 120, which is 220, and it becomes 110,000, which is my depreciation. Then for the lease liability, I recognize based on this, sorry, let's make it 10%. Either way, I don't want them to balance. So then I recognize my interest at 10% on the 220. And then I recognize my bank, the amount I'm paying at 100. Then this will balance off to have what? To have the lease liability. So this is the initial accounting. If you had done this for Joe, the examiner is not yet impressed. You have not yet applied FAC48624. Yeah, so yeah, I realized I made a mistake, and yeah, I'm cheating. So I'm cheating and then just changing the rate to make it 10%. Sorry about that. Yeah. So the rate is actually 12. I started with 12, so I just realized that, yeah, thank you for accepting my cheating. Yeah, but yeah, just to, I wonder if I say I'm cheating, then I'm not being unethical. But anyways, so now we've got this initial accounting, and the examiner, remember, you are busy in there. He's expecting you to have done this, because he's not going to give you marks for the things we see here. He's going to give you the marks for applying consolidation principles. So you are here. Now, the issue is, what does the group see? Let's deal with the group. So you responded to my question yesterday when I asked, what does the group see in all this? is the, like, let's number them. Does the group have any problem with journal entry number 1? So you are the group accountant. Do you have a problem with journal entry number 1? Yes or no? You are the group accountant. Do you have journal entry number, do you have a problem with journal entry number 1? Is what is done in that entry what you want to report on in your group financial statements? Yes or no? No. Why not? What's the problem with this, Lindy? What is the problem with this entry? Why are you, as a group accountant, are you not happy with it? So no, remember the first one is the one where you are fair valuing the investment property. So that means the response should then be, well, what Wusi is talking about there. That no, you are not happy with it, because you as the group, you are saying that, but the asset is still being used within the group. So it is owner occupied by the group. So as a result, step number 1 of pro forma journal entry number 1, pro forma journal entry number 1 is to say that I disagree that I have an investment property. So let me close off my investment property. Do you see that? Then you say that if it's owner occupied, it has to be a PPE asset. So that means you are, if it was never an investment property, it means that the fair value adjustment never existed. Do you understand the logic? If you are saying that this was never an investment property to the group, it means that the fair value adjustment never existed. So essentially, you close off the 1.2 million building, you reverse the 200 fair value adjustment, and you reinstate the asset of 1 million at its carrying amount. Do you understand that logic? So we are saying it's owner occupied in a group level. So this concept of investment property does not exist. So what do? I reverse the investment property. That is number 1. But if the investment property never existed, it means that the fair value adjustment never existed as well. So I reverse the fair value adjustment. And in doing this, I bring back the owner occupied asset that the group wanted to see, since the asset is being used to do what? To occupy. Then number 2, I then say that if this is true, it means that the group now has an asset which they can depreciate. So the group needs to depreciate the PPE asset. And the group is saying what? The group is saying, yes, I agree. And I remember that you gave me a useful life. What was that useful life? The useful life of the building was given as 10 years. Oh, all right, so that means we come and divide by 10. So this is the depreciation on the PPE asset. And it is what? It is 100,000 accumulated depreciation PPE. Do we see this? So this is journal entry number 2 at what? At a group level. Are we following, guys? So this is us doing what? This is us consolidating as they wanted us to do in Joe. So Joe, I told you, was a beautiful question, guys. I told you this. So I hope it is sinking in. Then the next thing is, therefore, we have dealt with this. Then we are saying what? We are saying that, but if there is no lease, therefore there should never have been a straight lining to begin with. Do you believe that logic? So if there was no lease, therefore the lease payments should never have existed. If the lease payments should never have existed, that means the lease straight lining should never have been spoken about. So that is what we now need to deal with. We then say, oh yes, so that means the lease income. So the lease income that we recognize, we need to reverse in journal entry number 3. So we remove the lease income because there was never a lease asset to begin with. So we remove the lease income of what? Of 150,000. So if the lease income never existed, it means the straight lining asset can never exist. So I have to remove the what? The lease asset that I had recognized, because there is no lease. Does that make sense? So there is no lease. So this does not exist. But remember that we are looking at the income side. So if we look at the income side, we need to look at the paying side. So on the paying side, if there is no lease, I cannot have a lease payment. So that means the payment made on the other side, this payment made on this side, it never existed. So I have to remove the payment that was made on the other side. So I cannot find myself paying a liability that I never had. That doesn't make sense. I never had this liability. So why am I paying for it? So I remove the interest cost of 22,000. Then what do I have? Then I cannot, where is it? Where am I sitting? So now I cannot pay off what? I cannot pay off the liability. So the liability cannot be paid off since it never existed. So I have to reverse. So this is what I'm doing. So what I've just dealt with, I have now said to the examiner that examiner, there was no lease. So therefore the lease income never existed. Examiner, there was no lease. Therefore the lease straight lining asset never existed. Examiner, there was no lease liability because there was no lease. So I cannot pay off something that does not exist. And therefore I cannot have interest on something that was never accrued. So as a result, I then deal with the income and the payment, and that's my journal entry number 3. Then I go to journal entry number 4, and I say, examiner, I believe that if there was no lease, then someone cannot have a right of use. So the right of use has to be removed, examiner. And therefore, there can never be a lease liability, examiner. So I am removing the 220. Do we see this? So we are now saying that this entry, the first entry we saw, it never what? It never existed. This entry never existed. And if this entry never existed, we cannot depreciate what does not exist. So we remove the what? We remove the what? We remove the depreciation that was recognized. So we reverse the depreciation, P&L, and we have accumulated depreciation right of use. And the examiner will be very, very impressed. So the guys at ITC, they were required to prepare this journal entry last year in Jan. And UNISA just wanted you to consider this thinking when you were preparing the SFP. So do you see what was happening in Joe there? Are we happy? Yes, I guess that's the joy of happiness. That's the icon for happiness. So is this for level 1? And this is not, so I think in fact 2 is not as clear as in fact 1. So fact 2 is not as clear as fact 1. That's something that we have seen. But I think the best way to confirm is to just ask the lecturers themselves. Because what I like about fact 1, they are clear what is a level 1 issue and what is a level 2 issue. But for fact 2, the only time they are clear is when we've got changes in degree of ownership and foreign operation. There is black and white situation. But if you are saying that this can be level 1, I'm more than happy for you to email the lecturer and share the feedback with all of us. That will be very useful for everyone doing level 1. So that will be very useful. Because as I said, the tricky thing is that it's not even dealt with in your tutorial letter during the year. So even if you go back, you will not find these things. So So show me level 5. General entry 5. Yes, just the removal of depreciation. So yes, will you help us with that, someone, to send an email to the lecturers and just confirm whether this will be expected for level 1, and you can then share the feedback with everyone here. Am I correct in saying we don't touch bank before, because effectively the company's cash cancels out? Yes, 100%. You know, you are making sense. So that is how it works. So you'll never need to worry about bank because it came from one group account to the other account. So there is no need to worry about it. It will just sort itself out. When they consolidate, it's just one cash account. Okay? Are we all good? So do we see that Joe was such an interesting question? Yeah, Joe is a very good question. Shame. No, I love it. There's just so many things you can learn from it. But I think this was what? This was the classic case. And as I'm saying, these things are what are so difficult to cover during the year. And that's why it's always appropriate to leave them here, because now you have gone through IFRS 16, you understand, you've gone through so much accounting and so on. And if you try to fit it in term 1, it just doesn't fit properly when we are doing IFRS 3 and intergroup transactions. So this is the best time, but I just want you to appreciate it because it's something that gets tested. So there's a question, if the list asset was PPE, how will then the first entry look like? So the first entry will then not be necessary. So the first entry will not be necessary. So in my example, the first entry is necessary because I said this is actually a building. But if it was just say what? If it was just say a normal asset, say a vehicle, any other movable property. So in that instance, the asset will have already been sitting in IFRS 16 and so IS 16, and you will not need number 1. Yes, so that's a good question. Yes. Okay, any other question?
Sorry, sir.
Mm-hmm.
To be honest with you, I'm still confused. This question is a big one. Like, I still need maybe to rewatch this video and redo everything from scratch. But what I would like to know is, in the group level, we are trying to reverse everything that we did because we concluded that it's not a lease, right?
Yes, it's always going to be that. It's always going to be that. It will never be a lease at the group level. So just to clarify and make sure we're on the same page. So it's not something that you need to assess even going forward. You can get into an exam and take it as given that at group level is not a lease. But yeah.
Okay. But why? How come then? Because at in the lessor book, isn't it we already like consider that it was an investment? I don't know, investment property, because usually the operating list, our first journal will be the gross income, the gross investment. But here, sorry?
No, it will not.
Oh. We usually have group gross investment bank.
Yes, and that's why Tammy is responding there to say for finance leases, yes, but this is an operating lease.
Yes, no, I'm talking about the operating lease. This is an operating lease. See, why are we not having the gross income then?
So that's not the accounting.
Oh, no, just a miss. So what are you saying? Is it the operating lease or is it a financial lease?
It is an operating lease. That's why the investment property is there.
Okay, let me just look at it. I'm just gonna look at the stuff again and try to.
Yes, and Yeah, and that's what was the point that I was trying to respond to, that I don't want to go into the lease accounting, but I'll give you the opportunity to go to lease accounting. I'll give you that opportunity, and I'll just pass the message to Arsene to just make sure you guys are sorted by the end of your sessions.
Okay, thank
Yes.
you, sir.
Yes. So I think I always find that some of the tricks that you're talking about, maybe the question here is saying, let's say we draw up the separate AFS as calculation, as per the calculations. Will we be wasting time in such an instance? Will it be beneficial? So I always believe that such questions depend on how fast you think and how fast you write. Because if you're one of those that think fast and you're able to then write it fast, then the same amount of effort that maybe takes someone to redo the entries, or it takes someone to think through the issues, might just be the same amount of time. So to me, whatever works, as long as you are comfortable with it. So to me, it's a personal decision. When I was confused, when I was doing this, to me, journal entries will then be quicker. Where now I'll be just writing debit D, credit R, because they are not required, but I know in my mind that D is depreciation, R is so on. So to me, that was how I will then make sure I'm not losing myself. So if you're not losing yourself, it's a matter of what? It's a matter of using the AFs, then that will be acceptable. As long as you do what? As long as you are mindful of the investment against the value. Okay. So that is change. So that is intergroup leases. You can use abbreviation in your workings. You can't use abbreviations in the final answer. And plus the logic is what? The logic is you cannot use abbreviations that are not known. So if I use DEP, no one can come in the room that is a CA and tell me I was so confused what the student was saying. They wrote DEP and I was like, what is this? They wrote LL, they wrote ROU. These are foreign terms to me. No, that person will just be being difficult. It's impossible that someone does not appreciate ROU will be right of use. I will refuse. No. But remember, for workings, I will then not say that when you do your actual journals, if they want journals, you use the ROU. There you will be required to either define it first and, or just what? Just use it in full. But in your workings, it's acceptable to use standard definitions. Like A/D is standard for accumulated depreciation, those kind of things. But it's workings where you might not need to explain. All right. All good, guys. Can we jump into changes in degree of ownership? So I think we've covered Joey extensively. Please go work through it, because as I was saying, that for me, it is just to give you what the examiner expected. Because sometimes those kind of questions are very overwhelming because you don't know what is it that he wants here and so on and so on. But now what we're going through, we're just going through what? We're just going through the principles. So that's where it is. Are we all good?